Hey guys, my name is Vyom Joshi, and today we will be reviewing Markel Group by answering 4 questions that Lilu always asks with any investment that he makes. Is it cheap? Is it a good business? Who's running it? And what did I miss? So first off, answering the question, is it cheap? For that, we look at Markel's 3-engine model using our consolidated sum of parts sheet that you can see on the screen. At the current price of about $1,880 per share, Markel trades at about 1.27 times its book value, which is about $1,477 per share. Valuing specialty insurance at 1.2x, segment book gives it the $8.2 billion valuation. So that's the engine one. With Markel Ventures, valuing it 11.5 times EV divided by EBITDA adds another $5.98 billion. So that's its second engine of Markel Ventures, which includes wholly owned subsidiaries and businesses within the Markel Group. And then adding $13.5 billion from the investment portfolio and float gives the total intrinsic value of $27.68 billion. So in a per share basis, that comes to about $2,196.82 per share. And that at the current stock price of about $1,880 per share would imply that the stock is about 14.4% below its intrinsic value. So that's the first question. Is it cheap? It looks cheaper. I wouldn't say it's a bargain bottom stock, but it is trading below its intrinsic value based on the assumptions and sum of part valuations that you see on the screen. Answering the second question, is it a good business? For that, we again look at the 3 engines. The first one is the specialty insurance, which has a combined ratio averaging between 94 and 95%. So that underwriting discipline, I'd say, is decent. Markel, over the past few years, was struggling with its underwriting a little bit, but since then, it has run off some of its businesses, and it's bringing that discipline back. And so the specialty insurance generates negative cost float, averaging between 94 to 95% combined ratio over time. So decent as far as underwriting discipline goes. The second one is the Markel Ventures. That engine is the non-insurance cash flows. So it's the manufacturing industrial services that get reinvested into higher return businesses, which either could be the investment stocks or businesses such as Lansing Building Products and Metromont Concrete, which are some of the businesses under Markel Ventures. So that's the second engine. And the third one is the investment engine, which uses insurance float and any profits that come from Markel Ventures. And again, Tom Gayner does a decent job at understanding opportunity costs as far as how to allocate capital. So when it comes to the investment engine, it's the money that comes from the insurance float and or the profits from Markel Ventures, which would then be used to fuel a long-term portfolio of high-quality equities, which compound book value per share at a higher rate. So it's the 3-engine portfolio with underwriting discipline, Markel Ventures, and investment engine. Like these 3 make up a flywheel, as Tom Gayner would say, that keeps Markel rolling. The third question that Lilu asks is, who is running it? And as I mentioned, it is Tom Gayner. Tom Gayner is has been the CEO of Markel since 1991. At least he has been overseeing the capital allocation at Markel since 1991. And Gayner applies a strict discipline, which is he buys profitable businesses with high returns on capital, and he only invests when he thinks that the management can be trusted. And then as far as the philosophy that Tom Gayner uses, it goes hand in hand with the way Buffett and Munger would value a company and approach investing. That is, he's not in it for the short run. He is going to be married to it. He's thinking about the long run, buy and hold type investor. And I'd say William Green did a pretty good job of portraying Tom Gayner in his book, Richer, Wiser, Happier. And so, again, he's a prominent premier value investor. And I'd say Markel is in good hands having him at the helm. He has repurchased $340 million worth of stock in 2025 alone. And some of the key equities in the investment portfolio is Berkshire Hathaway, Apple, John Deere, which is Deere and Company, and Sunbelt Rentals. And then we move on to the fourth question that Lilu always asks, which is, what did I miss? We want to know, what are our blind spots? Why is it that the market is really discounting this company? There has to be, market's not dumb. There has to be something that I'm missing. So there are two things that market might be missing, or market might be missing that it's not accounting for. The first one is the cyclical downturns. So unlike, let's say, Berkshire Hathaway, which has some robust operating businesses which are not cyclical, such as BNSF Railroad or its utilities through the Berkshire Hathaway Energy portfolio, Pacific Core, and so Berkshire's portfolio have these operating businesses which are very robust and are not cyclical. On the other hand, Markel Ventures owns cyclical construction and transport suppliers like Lansing Building Products and Metromont Precast Concrete and Hafco Wood. So housing and freight slowdown temporarily creates this operational drag on the business, which shows up during earnings and would affect Markel, even though it is on the cyclical side of things. So fundamentally, though, businesses aren't bad, but due to its cyclical nature, Markel stock suffers when there's a slowdown in those segments. And the second is the GAAP noise. Accounting rules require Markel to mark its $12+ billion portfolio to market every quarter, which creates severe headline earnings volatility because the portfolio can gyrate between new highs to new lows depending on how the stock market is doing. And so this $12 billion portfolio is the stock market portfolio, and you compare it with its current market cap, which is about $23 to $24 billion market cap. So again, the portfolio in itself is almost half of what the Markel's market cap is. So the bottom line is that the market mistakes temporary cyclical headwinds and GAAP paper volatility for structural problems, which allows long-term investors to buy into Markel. In this instance, it would be at a 14.4% discount to its intrinsic value. Again, I'm not a financial advisor, so please do your due diligence when you evaluate any company. But this is just an example of evaluating Markel using a 4-question checklist that Lilu follows. And overall, it seems that Markel is a decent company. Superior North owns about, or at least has about 20% of its allocation. So 20% of Superior North's portfolio is made up of Markel stock. So it's one of the biggest holdings of Superior North. And I hope you like this video. Please do like, share, comment, and subscribe. And I'll see you in the next video. Thank you.